The date is August 6th, planning out for, actually, it's August 5th today. We're planning out for August 6th. So we just had a topping formation and news that CTA buying is coming to a stop. They're at a 90 percentile long position looking to unwind. I have their long or their short um, positions marked off here on the chart 618.69 and 604.62 on the SPY. So once the price reaches those levels, expect it to just start cascading down. We had I forget what the levels were, but we had a CTA buying signal here as we breached the 200. And I think it was something at the time where it seemed unreachable. And I think it was about here. And once we breach that, you just see the SPY just kind of grow legs and run away with this lockout rally. As many people called it, the most hated rally because no one could participate because everyone just looked at the technicals, all the divergence forming, saying that, oh, the market should be coming down, but it never did. Just kept going, likely because the algorithms just kept buying everything up and causing shorts to cover over and over and over as people tried to short and hedge their positions. But now that we have this bearish Gulfian candle with this liquidity grab, we are now looking for further downside, potentially a chop for the remaining month of August. We have the August expected move low down here, kind of coinciding with where the 55-day moving average is. So that is a likely target for the next couple of weeks. And as I prepare for what to expect here, um, what I've been really looking at, a lot of people have been looking at, when we were going through this madness here, 2018, 2019, um, 2022, sorry, not 2018, 2000, 1998, 1999, mostly due to where the yield curve is and the Fed cutting rates into a flourishing economy, driving euphoria into the market for another year before the dot-com bubble bust. So I've been following those price actions from 98 and 22. And what really has been playing out is neither of those actually. It's actually the Trump V1 from 2019, 2018. So if we look here, and if I were to duplicate, actually, benefits of a white screen. So if we have two of these, okay. So we have SPY left, SPY right. I'm going to pull up 2019 and we'll look at that side by side. And you can see that time, date range. Okay, here we go. So if we go forward to current day, it is a damn near mirror image, right? So you can see this is actually the result of Trump's trade war with China during um, his first term, and you can see where it starts to chop and then comes down, chops around the 200, and then dips another violent trip down, right? This was about a 20% move over 82 days. This is current day 2025, this started 24. This is the infamous Jay Powell day, December 18th. I'll never forget that day for the rest of my trading career. And here we have when the trade war really started in earnest. and measured to the bottom, you have 21% over 46 days. So it's a little bit more truncated, right? In V1, we doodled around the 200 day before cascading down. Here we had a quick visit, a rejection, a failed rally, and then Liberation Day. I remember clearly this day, Liberation Day, because I was stuck long and got trapped. Anyway, and then you could see from there, we had a pretty much a straight V-shape recovery from the bottom, straight up locking everyone out because no one believed in this rally, right? So you had a 26% recovery over 126 days. Again, this is a little bit more truncated, where we had a rally to the top 32%. Very, very close. 126 days, 115 days, right? So you had a quick trip down for nearly 20%, 82 days, 48 days. I guess if you include Jay Powell, when the craziness started, right? 110 days compared to 100 or 82 days. Close enough, right? You can see the similarities here. Timeline's a little bit more sped up in 25, but nothing's going to be exact. Well, but using this kind of shows us, obviously it's not going to play out exactly right. You could see here we had that retest to the 200 immediately after breaching it, and then a rally. And then you had this uh, rising wedge breakdown for a second dip, which we had as well here in 25, and then a rally back up this final leg before in 2019, where there's this breakdown. Now, we're starting to breach the 20-day for the first time, getting underneath it. So if actually, let me put on the same indicators so we have something we can look at. Okay, so this blue line here is the 20-day, and you can see that in 2019, when we started to come down, we tested the 20-day, rallied up, gapped down, and then rallied up to, what is this? That's the 12-day. 12-day and the 5-day. Most importantly, the 5-day. 5-day is going to be our trend indicator, right? And you can see as we're doing that chop, the 5-day is starting to curl down. So we gapped up over it and then gapped under it, rallied up to it, rejected, and then you see that kind of gapping overnight motion where it's coming down, rallying up, failed rally, next day gap down, and then rally up. You see the several tests of the 55-day. That's what this line is. You test the 55-day, you come up, you test it again, and then you rally up for the remainder of the day. Then the next day you gap completely under it, and then you dump that day, come up, test the bottom of it, find it as resistance, come down, and then you gap down. It's just a lot of volatility, gaps everywhere. Gaps typically form when you have people pulling their stops out, either to the long side or the short side. So like if you come up here, usually when you breach, a good sign that you're going to stay above the 200 or any sort of major level is that you see just gaps as you move up. And you can see when we started getting up in 2019 above the 200, that there was several gaps left behind. And same here, right? You come up to the 200 and you don't get a chance to even react during market hours. It just gaps completely over. And I remember this was a Friday, and then Monday opened because there was announcement of trade deals and over the weekend, and there was just this massive gap. And a lot of people de-risked that Friday because we were so close to the 200 and they were expecting news over the weekend, whether it was good news or bad news. People didn't want to wait around. They just assumed that it possibly of bad news. So when good news came out, a lot of people pulled their short stops over the Sunday overnight session, and you just see the market rip. And it just didn't stop ripping, killed all the shorts, shorts covered all the way up. And now bellies are full, bulls are full, and buying has been exhausted. So now it's time for the bears to come back and eat. So what are we looking at here? What looking at history, right? What can we expect? Well, it seems like what we can expect is a lot of volatility. If it does play out as it did in 2019, you can see gap. There was no day here where there was no gap between the dates. Every overnight session had a gap to the next day, whether it was gap down or gap up. Gap ups were a lot more rare, right? You see that this rallied up on the close of business this Friday, and then there was just a really bad overnight over the weekend dump. There's likely news that occurred here that caused this dump. This was a 2.7% dump over the weekend. Monday opens up here and then just flushes the rest of the day. And then mid morning, it tries to rally and then it closes down here. And then it gaps up a little bit, rallies up to the 55, comes down, and then the next day it gaps down and then rallies up to the 55 day again, gaps over it. So if we were to play out something like this, right? We have this gap under the 20, we rally up to the 5, reject it, rallied up to the 5 and reject it. So we're somewhere around here if the timeline would play out right. What we likely should expect is several gaps down, several days of consecutive gap downs overnight. Whether or not it rallies up or it flushes during market hours, you can see that it rallies up, gaps down, flushes, tries to rally midday, comes down, gap down next day, gap down. So let's look at this on a daily scale. So going back to 2019. So these are now daily candles. So it's clear where the gaps are. Green candle bar, green candle bar. So that means day open down here. So this was a gap down, gap up, gap down, gap down, gap down, gap down, gap down here under the 200 double exponential moving average. I like to use that just because sometimes it respects it. It's a good demarcation for levels where your other moving averages don't really tag. It's really minor, a minor level that gets punched over a lot. So it's not always useful, but you can see there are times where if you're looking for where price is going to go on some scales, that the 200 DEMA is actually um, something that does point out areas of interest. Don't ask me how or why, because I'm pretty sure very few people are actually watching the DEMA. These are it likely just coincides with some sort of VWAP somewhere where someone else is watching. all these indicators are really self-fulfilling prophecies where a lot of people believe in them. The more people that believe in an indicator, the stronger those indicators will become areas of resistance and support. And that's why indicators like the 5-day and the 20-day are so powerful. It's because everyone's watching them. So a lot of people will set buys or sells based on those indicators. Anyway, that's a conversation for another day. So in the bigger picture, in the next month or so, I think the idea is to really favor overnight gap downs, regardless what the price action during the day is. Um, More likely than not, you're betting on a gap down overnight would print. And this, I mean, logically, right? If you think about a down trend, that's exactly what it is, right? You have more favoritism to the downside than to the upside, right? So like when you were running up, a lot of the gaps were gap ups overnight. So if you were betting price action overnight, you would print a lot, betting long, swinging longs. So here, looking at 2019 again, we have a 6% drawdown. If you were to count the wick, you have 7.35% before it bounced across 33 days. So if we were to think about how this timeline has been more truncated, right? So let's take a look at that again. We have this rally from trough to peak, took about 126 days. Trough to peak in 2015 or 2025 took 115 days. So we're talking about a about a 9% faster timeline, right? If we were to look at this flush down, this flush down, we have almost a double the speed in which this flush happened. So we have double the speed down, 90% of the speed up. So no correlation there. Just figured I'd double check to see if there was any way we could use that history to build a pattern here, to give us a little bit more correlation. But no correlation between the speed of which this is going to happen. So if this were to play out at 100% timeline, you're looking at about a month worth of 336. Okay. So this is stretching. Oh, it's quite a bit past. So this is 318, 318. All right. So then we would expect this to come all the way down here. This is 33 days. If we were to just tag the expected move, that'd be a 4%. Punching through there and arriving where we did in 2019, which is just beyond the 200-day, would be almost 8%. So if we were to tag, I feel like the target, if you were to go short, is I would target the expected move first, take profit, and then look at where price action is. Because obviously, there's just because this happened before doesn't mean it's going to happen again, picture by picture, right? In fact, you see how their price came down to this level. This was I think it was just like 5%. Yeah, this is 5% down, and then it rallied up to I think that's the 12-day. Yeah, this was the 12-day. And then found the 12-day as resistance. It gapped up over the 55 and the 5, tagged the 12-day, tagged, almost touched the 20-day, and then closed by the 12-day. So essentially, it found the 20-day as resistance as it tried to rally up, and then came down, tested it again, didn't have the strength to continue. There's no bullish continuation here to stay over the 55-day, and then you saw capitulation over the next couple of days, right? This, if you were to cover your short, you don't necessarily have to go long, and you just wanted to watch how this was playing out. Even if you miss, you don't catch the top of this to short all the way down. Let's say you come up here, you see this as resistance, you come down, and you think that this might punch all the way through, and you catch only this part. That's still 12 days and a 5% move down. So if you can hold a short, even if you cover at 200, that's still 3%. More than enough to make some profit. So I think the plan for the next couple of days is, if you don't want to, make a prediction of where the gaps are going to be, where the rallies are going to be, you could take a longer dated put, because that's going to print money all the way down here, despite the chop. I mean, you can add to the put position as it rallies, or you could, every gap down, you close it and then you re-enter it. But then you're basically predicting the price action of every day if you're doing that. Because if you close it on the gap down and it just keeps flushing, and you want to try and capture the overnight action, then you're missing out on the entire flush during the day. If that doesn't sound appealing to you, then you might add more as it rallies. I don't know. You could come up with your own plan as you review this correlation here, but basically expect a lot of gap downs, rallies, you know, roll around price action. That's just going to chop people up, and that's basically what creates the gaps, right? People being chopped up and pulling their stops overnight causes the price action to gap in a particular direction. So looking specifically at current year, then if we were to come up with a plan, I think it's really key to watch the levels where you have gaps and you have a lot of liquidity built up where the price stayed for a while. What you could do is use anchored VWAPs, or I like to use volume profile, and you can see areas of control. So there's a lot of congestion here. This point of control here tells you that there's a lot of people positioned who either long or short in this area, right? So likely price is going to find support or resistance in that area. And here I have a value area of 40%. So you can see that price will likely find a lot of turbulence in this area because that most people are going to be positioned in from June on in this area. So once we get out of these high volume nodes, you see this gap here. Their price could chop through here very quickly, or you have to look at if there's fair value gaps, that there could be unfilled orders, unfilled auctions, incomplete auctions in this area that could form a almost like a secret support level, right? So instead of trying to predict where those are, instead keep in mind your um, Bollinger Bands, your um, vol calculated expected moves. Every level down is going to be crucial if you want to catch bounces and figure out where price is going to stop. But I think the key really is going to be looking for divergences and volume capitulation near the bottom. This was actually very concerning how much volume kicked in on this sell, and then immediately on the 4 hour we were oversold. So I'm pretty sure people got trapped seeing this. They got very excited, like, oh, okay, time to go full port short, and then they get screwed once it gapped up, right? And that's kind of what causes these gaps is people get stopped out and then they have to cover their short, or they let go of their puts, and then the market makers de-hedge, causing more buying. But then um, but obviously there's no active buying, people trying to get into position, just people unhedging, and that is why we can't get over uh, these moving averages. And you see that we're wearing this as a hat, is like I like to say, when we curl over like that, we wear a moving average as a hat. We'll just come over and continuation to the downside. You'd see that here. We start wearing this as a hat, cup and handles, head and shoulders. It's all these rounding formations, right? That tells you um, buyers or sellers are essentially running out of steam. But you can see that here. Likely tomorrow, I'm going to bet on a gap down, um, just because there's from a macro level, there's just no buyers really willing to push this further into um, the upside at this moment. Okay, so to sum everything up, expect chop down, probably a major support level here on the 55-day. There's a lot of gap downs, run ups. It doesn't matter how in what order that happens. Expect this to come down to probably test the August expected move low, bounce up, fake everyone out. Everything's going to be okay. We're going to come up over the 5-day, the 20-day, and the 12-day are going to be pointed straight down. We're going to find those as areas of resistance, and then just capitulation beyond the the monthly expected move. So that would be if we were to come down and do like a 5, 7, 6% move, right? I don't know if I'd expect it to come all the way down to the 200-day, just because the expected move, that would be like 2 or 3 standard deviations down. Um, Obviously, it could happen if the CTAs start to unwind, right? If you come down here, all of the CTAs at this level start to turn on the selling algos, getting out of their long positions, pushing this down. You have a gamma squeeze to the downside as market makers have to hedge for the additional puts going in the money, and that pushes this down, pushes this, activates these secondary CTA selling algos, and it just cascades down, right? And that's what would cause kind of large flushes and gaps down. That would kind of be the gameplay to reach the 200-day, but we're so far above it that I don't know if we were to come down and test the 200-day, I expect that to extend to probably September. Um, but I'm not gonna. I don't have a crystal ball to tell you where this is gonna go. I just know that most people are favoring the downside, and that's going to become a self-fulfilling prophecy. If the bulls believe that there's more downside, um, they're not going to step in the way of a falling knife, or at least there's going to be fewer people willing, right? Once you start coming, recovering those moving averages, all the people who are locked out of this first move up expect that to punch straight up as people see this as the opportunity for them to get in. Um, and what will likely form at that point is a 1, 2, ooh, Elliott wave, 1, 2, 3, 4, and then likely 5 somewhere. Um, but since this is a more macro formation, you could usually uh, a corrective wave will be a 1, 2, 3, and then so it'll be A, B, C, and then wave C is a 5-wave move. And then you're going to see capitulation, potentially a double bottom forming divergence on the RSI and the MACD. And then you're going to see a 1, 2, 3, 4, 5 miniature wave pushing up to complete this more major Elliott wave. And then you're going to see a bigger sell-off. Let's see if there's any correlation to 2019 for something like that. Well, I guess that's just COVID, right? That would be the major black swan of it. Or it could just be, right, you see that this has more of a pullback in time before we continued onwards, but that would be the um, major Elliott wave here. So 1, 2, 3, 4, 5. Wave 3 has to be the largest wave, most powerful wave, and then you can see wave 4 cannot exceed 382. And then you see the blow off. Wave 5, and then this is a flat corrective. I forget how it's supposed to go, but I think it's like AB. It's still a ABC wave, but it stays within a range, and it's just the pullback in time. Um, Wave A. You have to Google it, but there's Fibonacci relationships between the 3 waves, and then that's what you'll know that wave the correction's complete. But we're not going to look that far into the future. That's obviously going to be um, at this point we don't know how much correlation to 2019 we're going to have. Um, I'm always looking at patterns going back in history to see, because I mean, if we follow this to the T, right, we're expecting a black swan event sometime in 2026, or potentially if this is more truncated, right, end of 25. Who knows? We could be. Yield curves uh, uninverted. We have a weak job market, inflation's increasing, Fed's going to be forced to cut, forcing a steepening of the yield curve, which is usually the telltale sign that precedes um, a recession. So trade like water, but in this immediate future, expect some downturn. And that's it.